Max funded IUL gets cheaper as you get older. In this episode, I'm going to address the question, what kind of life insurance costs less as you get older? Get ready. This is going to maybe surprise you. It's not what you may be thinking. So I'm Doug Andrew, and I've actually been licensed ever since 1974 is when I got my insurance license and my Series 1 securities license. I don't think they even offer a Series 1 license anymore. You have to get a Series 6, 7, 63, 24 to include all of those. But I sold millions and billions of dollars of life insurance to my own clients from 1974 until 2005, when I let all of my licenses automatically expire at the end of that year. Why? To become a consumer advocate, to educate the general public and advisors, and start a radio show and write books. And I am so grateful. We've had 12 books that I've authored so far that have been very well received, and I am grateful for that. We had one become a New York Times and Wall Street Journal #1 bestseller. But in all of these books, most of them talk about financial asset optimization and tax minimization. And my favorite vehicle to accumulate money tax-free for all kinds of goals, retirement, working capital for business, emergency funds, real estate management, on and on and on. My favorite vehicle is a max-funded indexed universal life insurance policy, if it's structured correctly and funded properly, which if it is, I call a laser fund, which means there are a lot of IUL policies out there that would not be qualified to be deemed a laser fund because they're not structured correctly and funded properly. If they are, they pass the liquidity test, safety test, rate of return test with flying colors, and they're tax-free to boot if you make sure your grandfather to keep them tax-free during the accumulation phase, the access or distribution phase, when you retire, when you're taking money out, and when you ultimately die, anything left in there blossoms and transfers income tax free. So many times people say, well, golly, doesn't universal life cost more and more as you get older? A lot of whole life insurance agents are critics, and they are taught to say, oh, a universal life, it will crash and burn when you're in your 60s and 70s because the cost of the insurance is going to go through the roof. And I go, oh my heavens. They don't know what they don't know, because if you structure universal life correctly, it is way cheaper than whole life insurance. In fact, the older you get, the cheaper it becomes. And I have another episode on this very channel that talks about that. But in this episode, I'll explain why the insurance does get cheaper. Why does it cost less as you get older? So all life insurance, whether it's term, whole life, or universal life, has a cost or term insurance component. So a lot of times people will buy a whole life policy because with whole life, you're sort of overpaying the early years so that you're underpaying the later years. And so you're covered for your whole life by paying a level premium. And you are paying way more during the early years. If you took one out, let's say at age 25 or 30, you're paying way more than the actual cost of insurance, and that builds up equity or cash value in the policy, which down the road, as that cash value grows, and it grows tax-free, tax-favored. Then as you turn 55 and 60, 65, when the actual cost of insurance is higher, then that cash value and the dividends, the growth on that cash value covers that. So hence, with whole life, you're really doing it for a death benefit, for life insurance to pay out when you die. And that's what whole life was really built on, a chassis to provide a death benefit your whole life, where you're overpaying the early years that allows you to underpay during the later years. And so whole life agents have this in their head that the cost of the insurance goes up. And with universal life, they go, oh, the cost of insurance is going to go through the roof and those policies will crash and burn. No. So let me explain how universal life actually gets cheaper as you get older. As you pay premiums into a universal life policy, you can have the premiums and the cash value that is growing qualify as part of the death benefit. You don't have to do that. Some people say, well, I want the cash added on top of the death benefit. Well, then the cost of insurance will keep going up. No, I'm using it for living benefits. I don't care about the death benefit. It's coming along for the ride. If it wasn't there, then it wouldn't be deemed tax-free life insurance in the Internal Revenue Code. But I want the cost of insurance to get cheaper. So as I put money in and that money grows with cash value, that becomes part of the death benefit. I am self-insuring. So let me connect the dots, but before I do, if this is intriguing you and you can think of somebody that ought to watch this episode to get educated, be sure and share. Click like, post a comment. But most importantly, subscribe to this 3-Dimensional Wealth YouTube channel. Why? Because I post an in-depth answer to a financial question almost on a daily basis. I don't want you to miss out, so click that little bell so you'll be notified every time I do post a video. But stay with me to the end. I want to gift you a copy of my 300-page best-selling book, The Laser Fund. Don't pay $20 for it. I'll gift it to you. So here we go. So if I maximum fund a universal life policy, which many of my clients and my students do, let's say that they want to reposition $100,000 to increase the liquidity, safety, rate of return, and the superior vehicle, if they understand it, is a max funded indexed universal life policy. Indexed because you want to participate when the market goes up, but not lose when the market goes down. And indexed universal life came out in 1997. This is where I have increased my average rates of return on my universal life by usually about 2.5 percentage points. So my average returns have been between 7 to 10%, probably closer to 9.6%. So this is incredible as your money grows. Now at 9.6%, your money will double every 7.5 years. So let's say that you designed a universal life policy to accommodate $500,000. And if you want to comply with TAMRA, so you can access your money tax-free anytime down the road, retirement or for whatever purpose, you have to do that in basically 3 years and 1 day or 4 years and 1 day to comply with TAMRA. But let's just make this simple. If I'm going to put in $500,000 and as I do that, every time I pay $100,000 or $125,000, as I do that, that premium payment and the interest that I'm earning on that in the policy qualifies as part of the death benefit. So if I open one, let's say at age 60, for a 60-year-old male that wants to set aside, let's say, $500,000. That's called the guideline single premium. That's the most that you can put in during the first 11 years under TEFRA and DEFRA. The minimum death benefit is approximately $1,250,000. So I could buy way more life insurance than that with $500,000. That's not the objective. I want the least amount of insurance the IRS will let me get away with. So at age 60, that's about $1,250,000. So that's the death benefit. I put in $500,000. Now, if I died, what is the actual net amount at risk to the insurance company? Because they already have $500,000 in there. That's your money. So the difference is $750,000 at that point. So they're only going to charge you, okay, the actual COI, cost of insurance, that goes up per thousand as you get older, but the amount of thousands they're covering you for has gone down. Now they're only on the hook for $750,000 once $500,000 is in there. Does that make sense? Well, at 9.6% rate of return, that $500,000 is going to double to $1 million in what? In 7.5 years at 9.6. So in 7.5 years, when $500,000 of cash value has grown to $1 million, and many of our clients have experienced that and even higher, now how much is the insurance company at risk for? The original death benefit was $1,250,000. Now you have $1 million in there. They're only on the hook for the remaining $250,000, not $750,000, not $1,250,000. So even though the cost per thousand goes up, the amount of insurance at risk has gone down, and so the cost of insurance is getting cheaper as you get older. Let's go one more 7.5 years. That $1 million of cash value doubles to $2 million. Okay. Now you have $2 million of cash. Well, the original death benefit was $1,250,000. That's more than the death benefit. So Tefra Defra tells the insurance company, you've got to have the death benefit now come along with the cash value, and usually there's about a 5% difference. So if I have $2 million of cash value 15 years down the road in the policy, now the death benefit has increased from $1,250,000 up to $2.1 million. But the insurance company is only charging you for that last 5% or 100,000. If you do the math, when I have $2 million of cash value, the interest on that $2 million, let's say at 10%, is $200,000. The insurance company is only charging me for $100,000 of death benefit. That's minuscule. And we've had clients that $2 million doubles to $4 million in another 7.5 years, and $4 million doubles to $8 million in another 7.5 years. Now the cost of insurance is super cheap. In fact, it is so low that if you analyzed in one given year, 30 years down the road, if the rate of return that year was 11%, like a lot of clients have earned this year that I'm recording this episode, 2021, some have earned as high as 32% and even 61%. Well, the actual cost of insurance is maybe only 0.1% less than that. If I earn 11, I net 10.9. It's gotten cheaper. Whereas over the life of a universal life policy, if I were to average 11, I would net 10. Only one of those percentage points was required to pay for the insurance that the IRS had to be there in order for it to be tax-free. But hello, is it really a cost? No. Here's why. If I have $1 million, $4 million, $8 million, and that money is growing tax-free, and if I am earning, let's say, an average of 9.6 or 10 or 11, actually I've been able to average about 11.17. Let's just round it down to 11. So there are many people who might earn 11 gross and net 10 over the life of their whole life policy. And people say, well, yeah, that's 1%. Well, hello, many asset managers charge 1% or more, but listen, no, it's really not a cost. Because I earn 11 and net 10, if I have $1 million nest egg, that allows me to generate $100,000 a year of tax-free income without depleting principal. There's other episodes that talk about this phenomenon of how you can get 10% payouts even if you're earning just 8% by using the smart way to access money, index loans. But this is the point. If you earn 11 and net 10, that 1% is money that would what? Otherwise go out the window in what? Tax. If you follow the herd, like most people who put money in tax-deferred IRAs or 401ks, you would have to earn 15% or higher in a tax-deferred IRA or 401k to net 10% after paying tax when you pull out the money. In order to net $100,000, you'd have to pull out $150,000 in a 33% bracket, pay tax of a third between federal and state on the 150 to net 100. And by the way, your $1 million nest egg will be gone in 11 years if you do that. With a universal life, I only have to pull out 100 to net 100 because it's tax-free. I'm actually earning 11 and netting 10, but that's better than having to earn 15 to net 10 in a tax-deferred IRA or 401k. So if this is intriguing you, I can prove to you mathematically a properly structured, maximum funded, indexed universal life is the cheapest insurance policy you will ever own when you maximum fund it. It will not crash and burn. In fact, it will outperform whole life hands down. And I can prove it to you mathematically. If you want to learn by reading, I want to gift you a copy of my book, The Laser Fund. So here's how to claim your free copy. You go to laserfund.com or click on the link below, laserfund.com. And you will be sent out this 300-page book. It's been flying off of our warehouse shelves. Now, you must contribute a nominal amount towards the shipping and handling. You got to have some skin in the game. I'll cover the rest of that, and I'll pay for the book. And I'll send this out to you. This side is 200 pages, 14 chapters with all kinds of charts and graphs and explanations. If you learn more by stories, you flip it over and read this side. This is 100 pages, 12 chapters with 62 actual client stories. Now, When you're in that site and I send you out this copy, there's options there also to listen and learn and watch and learn. But check out a few of our educational events like Retire by Design, RBD. We usually teach one at least virtually or live once a month, and you do not want to miss out on those opportunities to do a deep dive into understanding this better for your brighter future.